Okay, so this is an example just for fun. I'll show you how to reduce the risk, the standard deviation of your financial portfolio. So our data is weekly stock returns, I think, from uh, Exxon, Walmart, Microsoft, and Apple. The most recent observation is from 2016, and the oldest one is from 1986. So the observation is more than like 1500, right? So 1569 observations we have, right? So there are just four stocks that I chose. Let's first see how they are correlated. I will use covariance correlation matrix, correlation table, and we'll choose this. And I am going to just include the table here. So choose output range, and I will choose this cell so that the outcome is reported here, right? So we have correlation coefficients like that. That means all the stock returns are positively correlated, right? So the weakest correlation is Apple and Exxon, which is correlated by 0.17. And the strongest correlation is this, Microsoft and Walmart. They have correlation 0.3367, right? So anyhow, all the coefficients are positive, correlation coefficients are positive, and then let's calculate standard deviation too to see to compare the standard deviations. So the standard deviations are calculated this way. So let me increase the font size. So we have this correlation coefficient, and we have this standard deviation. Let's just simplify them to 3 decimal places. Okay, so standard deviations, as you see, Apple is the riskiest stock among them, and Exxon is the safest one, right? So now I will show you the optimal weight portfolio. I calculated the optimal weights based on the theory from financial economics. These are the optimal weights on these stocks. So I will invest like 60% on Exxon and about 25% on Walmart, about 10% on Microsoft, and about 4.6% on Apple. How do we do that? So portfolio will be weighted average of this, like this times Exxon plus this times Walmart plus this times Microsoft plus this times Apple. But I have to fix the weight. Then you put $sign in front of that. That means even if I extend it to this, the $sign numbers do not change. So as you see, this is based on the second row, and this is based on the third row, but this area does not move down, right? So this area move down as this goes down, but this area does not move because I put $sign. Anyhow, like this portfolio is extended to here, the very first period, right? So then this is optimal. Let's see how much standard deviation we could reduce. Standard deviation of this new portfolio is 2.4, right? So this is the minimum possible standard deviation, like by weighting by as a weighted average of these four stocks, right? So, and as I said in class, what's surprising is the uh, smallest standard deviation is actually safer than the safest stock, right? So the safest investment is not the safest asset, but it is a combination, optimal combination of many assets are the safest one, okay? And also, of course, I did not consider the expected return, average returns can be calculated, but so uh, that's also a very interesting and important uh, point you have to consider when you decide your investment. But it's just for fun, as a fun statistical example. Okay, thanks. I will continue in the next chapter.